Electric Avenue, and then we'll take it higher.
Woo! Episode 45, True North. We are back. That was the best woo I could manage with these prices. I thought, you know what, I had to practice my Ric Flair woo a little bit before the show. That clip, or excuse me, the music was supposed to be a connection to the London Stock Exchange, because I initially thought that stream was going to be out of the London Stock Exchange, and then I was like, ah, crap, it's Luxembourg. But it still fits, and 10 points for Gryffindor if anybody can figure out the connections. But with that being said, we're going to have a great show for you tonight. Jeff is here with no sleep. We got Dan. We got Mike Grain of Salt. And I'm going to kick this off with a little bit of a history lesson, and something that I've been binging, like history podcasts. And so there's a guy named Professor Jang, and he went over all revolutions. And I'm assuming that anybody that's here watching is here for the revolution, right? We're thinking that Bitcoin is taking over the world. And what he said was that every revolution has three principal characters in them. They are the poet, the prophet, and the prince. The prince is also kind of like the warrior general, but then you don't get the triple P alliteration. So we're gonna go with PPP here. And I'm gonna talk about the French Revolution as a pretty good example. And in that scenario, the poet was Rousseau. He wrote The Social Contract and popularized the idea of the will of the people. And the prophet in this scenario was Robespierre. He led the population through the next phase. Unfortunately, this little particular part of the revolution was called the Reign of Terror because of its liberal use of the guillotine. And the prince of the French Revolution was Napoleon. He basically channeled the revolution, declared himself the emperor, created an empire, and dominated most of Europe. Now, if Bitcoin is an economic revolution that's imposing the global free market on the world, then the poet is clearly Satoshi. I think that's just pretty logical assumption. The prophet, and this one is just my opinion, you could probably go with Saifedean or find another half a dozen OGs that you think is meaningful. But for me, it's Jeff Booth, the author of Price of Tomorrow, a thought leader, and seems to be clearly see the future as it will become. And luckily, we've got proof of work and digital power now, so we don't really need heads to roll this time around. And that leaves the prince. And I've been thinking about this for a few weeks, but then during the earnings call, when I heard Saylor's response to Ben's question, and I quote, "We want to eat the world," end quote. That was confirmation for me that the prince of the revolution is Michael Saylor. And right now we've got the number of economic nodes in the form of companies stacking Bitcoin will only ever increase from this moment. So with that being said, despite my bullish long-term outlook, we've got blood in the streets, and Bitcoin and strategy are back to early 2024 levels, sentiment circling the drain. So what are your gentlemen's thoughts on the current price action and or my delusions?
I like your delusions. Price action is horrible, right? I mean, the price of strategy is going through a rough patch. So this has been pretty brutal. But easy thing is to say, zoom out and you look at the broader picture here. You had the opportunity to buy MSTR at these prices in March of 2024 when they had 200,000 Bitcoin on their balance sheet, maybe less, maybe 160,000 Bitcoin on their balance sheet. And if you like the company then, and I think you'd like the company even better now. And I think somebody posted this. It was either Mark Harvey or Lee. It was a video from Warren Buffett mentioning if you walked into the grocery store and your groceries were 50% off for the day, you'd be jumping around, you'd be hooting and hollering. And yet in the stock market, if the stock's down 50%, everybody's running for the exits. And so like the stock must be telling me something. That's what he said. The stock must be telling me something. And it's a marketplace, right? There are multiple factors at play in all different directions. And really the thesis is unchanged. So if you like the company when it was trading at $500, you should like the company when it's trading at $193. It's
Yeah, my
it's on
thesis.
discount.
Yeah, my thesis hasn't changed a bit. It's always been from the very beginning. Strategy's disrupting, and it's the clear winner. And I think that the prefs are actually have them in a better position than the convertible bonds. So nothing about my thesis has changed, and no part of my thesis is, like short-term price action, right? That's not part of it. In 4 or 5 years, if if we're still trading at these levels, then I will have to revise it. But it's a long-term thing for me.
The tough part is, right, like you're talking incredibly long conviction in an increasingly shorter attention span world, right? I can get anything delivered to my house in less than an hour from Amazon, and like you've got attention spans are getting shorter and shorter and shorter. Like nobody's watching movies anymore, like because they're 2 hours long. Like it's you can see it everywhere. And then you ask somebody to, hey, you should hold on to this for 8 years because it's super volatile. And if you hold on to it for a long time frame, you're going to be okay. Like that's really hard for people to focus on one thing and just have a dead guy portfolio and sit on their hands for 8 years. I mean, bravo to all of the Bitcoiners that have been holding on for 4+ years, because that takes a ton of conviction in order to do that. Or it's a high volatility asset. You've got to be able to withstand multiple 30% drawdowns, 80% drawdowns, and ride it back up the other direction. Like that takes supreme conviction. Can you trade it? Sure. Are you going to nail it? Probably not. 99% chance you're not going to nail, like sell the top and buy the bottom. You can shoulda, coulda, woulda your way out of the whole thing. It's a very difficult to trade these high volatility instruments without having incredibly complex AI algorithms competing against Jane Street and HFT and all these other trading companies. So yeah, there's so many things going on here, right? So many, just as you have reflexivity to the upside with all these passive flows on index funds and ETFs and all of those things as well. QQQ, S&P 500, Russell. As the stock gets larger and larger, you get a larger and larger allocation from these index ETFs. And as the stock turns around and goes the other way, you get the inverse action. You're getting a smaller and smaller allocation. So those index ETFs that are holding MSTR stock are selling into weakness. So you're going to have it, reflexivity going both directions. And if it's on the back of the most volatile asset on the planet with Bitcoin, you're going to get double volatility, like on both sides, right? So you've got this amplified volatility with Bitcoin, but it's accumulating over time. It's growing over time. And you can see that with how much Bitcoin they started with, how much Bitcoin they've got today, how much Bitcoin they continue to accrete, the design of the leverage that they're taking on, all of these other things. So, I mean, there's so many things going on, but I like these prices here. Like my conviction hasn't changed at all. In fact, I think it's significantly stronger today than it was a year and a half ago, because I can see like the path forward. Like what are the products that they're going to offer? It's going to be digital credit products into the future. A year ago, we didn't know that, right? We saw the convertible debt. The convertible debt was appealing. We're like, okay, people are going to want to buy these, but the problem is people can't buy these. Retail can't buy the convertible debt. All right. It's OTC 144A. It trades between 30 dudes, sitting behind the scenes, trading back and forth to each other. And now you've got these new instruments where you've got people that are long the credit quality of Bitcoin, not necessarily long the volatility. And you've got a company like sitting on an enormous pile and high credit quality to go issue these things to the market. Like, if anything, I'm significantly more bullish about the future with this structure than anything I knew previously. So
Yeah,
I like
learned. Yeah, I haven't learned anything bearish about the company personally. The only thing I learned in the last year is, I'm a little bit more bearish on my ability to trade it. But to be fair to the traders, to a certain extent, like Bitcoin is a forever hold because it's sovereign, and so kind of on a technicality, anything that has third party risk is technically a trade. Like, I know there's people who want to forever hold certain stocks, but you still have to watch the management team, right? So the management, one management team rolls out and the new one rolls in. If they change how they do things and you don't like it, you might have to revisit, that forever hold status. But if they continue to execute well, then yeah, it could be a forever hold. But you still have to watch it, I think. But you don't have to really watch Bitcoin. You just know that it's going to be good to go.
Yeah. Also, pause real quick. This is True North, the investment grade Bitcoin podcast. Everything we say here, none of this is financial advice. This is for entertainment and educational purposes only.
Yeah, I forgot that part.
And if you're new here, we talk about Bitcoin securities, we talk about digital credit, we talk about everything under the sun related to the financialization and the future of Bitcoin securities. So
and everyone but you is an independent voice.
Right. Yeah, exactly.
So I get to run my mouth and say a bunch of
you guys can say whatever you want.
And you just got to sit there and take it, right?
That's exactly right. That's exactly right. Well, I mean, Dan, Mike, what are you guys' opinions? Obviously, I mean, this is tough price action. You hate to see it, right? Like this is it's not going the right way. Everybody loves green candles here. And then on top of that, one other statistic is JP Morgan has increased margin requirements from 50% up to 95%. I think like just on MSTR just in the last week.
Shit.
Just in the last week. So not only did they go from, hey, Bitcoin is good, we think it's good collateral, we're going to start lending against it, to taking this perspective, and now we're actually going to increase the margin requirements from 50 to 95%.
So they might have forced a bunch of people into margin calls.
Yeah, it sounds like what it is. And I mean, that's a diabolical move, but I don't think it's a reflection on Bitcoin. It's a reflection, like the stock's gapping down 10% a day regularly. Like you're going to up the margin requirements. Like there's probably an algo that just indicates to them, whether or not the margin requirements have changed on the equity, or they have a risk management department. And
so let me chime in on the margin thing. And so I don't have an account at JP Morgan. I'm not giving financial advice, but when you go in and you look at your stocks, I use Fidelity. If you buy stock on margin, the default setting sometimes will it depends upon how your account is set up. If your account is set up for option trading, depending upon what tier level you are, what happens is when you go to buy a stock, the default setting will trigger you buying the stock, even if you have cash in your account on margin, because then it allows you to clear out a trade faster, even when you buy it on spot. So what happens is you buy it, it shows up that it's on margin, right? And really you call them up and you find out, no, it bought it for cash. And so what you need to do is you need to go figure out which brokerage house you're using. If you're not an option trader, even if you have no options, you have to see if it automatically purchases your spot shares with on a margin basis. Okay. And that's important to understand. And so what I did was, again, this is not financial advice. When I did the first change to option status, they automatically defaulted it to everything was purchased on margin. And even if I had cash. And so then what I did is I said, you need to give me a toggle so I could turn this off. And so the default setting is to buy on margin, but then I turn that off and make sure I buy for cash. So that's just a useful tip to make sure you might unbeknownst buying something on margin, even though you did not intend to do that. So
that's
again,
wild.
I don't have JP Morgan, but if you just never had that enabled, it should not be a problem for you, but you should check. And just like you'll see a little circle and it says an M in it, and that means margin. So, look, this price action, this RSI on the daily level is even lower than it was in April. So RSI is the relative strength indicator. And so if you go all the way back to February 24th, the RSI dropped down to 28. Now, when you get under 30, that's oversold, right? That means so many people have sold that the indicator showing that. That's on the daily chart. But in this particular run on Monday, we got down all the way on the RSI down to 20, down to 25. And that's a really, really low number because you have to go back 2 years to when you see an RSI number get that low. And so from that perspective, this sell-off is worse than what it was in February and April. But I think, I did a poll
on tariffs.
And I said,
and that February, April, that was like the big tariff scare. Is Trump going to drag the economy through the mud for the next 8-12 months? Like we don't know.
Right. And so where are we today? It appears that, I did a poll on the debasement trade. Look, there's two big debasement trades going on right now. One of them is in the US dollar. Do you believe we have a $2 trillion per year fiscal deficit? Not going to get fixed. We have $1 trillion in interest payments. It's the number 3 line item in the budget. So that means we spend $1 trillion every year that just goes to paying off the debt of $38 trillion. The big, beautiful bill allows it to go to $41 trillion. So that has not changed, right? So now we have this liquidity held up. What does that mean? Well, there's two debasement trades. One of them is $1, and the other debasement trade is the white collar worker being displaced by AI. Now, if you're being displaced by AI, it seems like you better get some of the artificial money to combat the artificial intelligence. That's just my view of this. So, the price action, horrible. I just want to be straight up. Price action is horrible on MSTR. And I think that from that perspective, to quote Ben Workman, I didn't come up with this idea. He said, can't rent your conviction. You have to have your own conviction, do your own research. Why are you in this? And I've been in this now. It'll be 3 years in January. I don't consider this a trade. I consider investment. When I buy options, that's a trade because there's always a term on those. But with that said, I just want to acknowledge that everybody that's on this call right now is that the price action in MSTR common shares is terrible. Absolutely terrible. Do I think it's going to get better? Absolutely. Otherwise, I wouldn't be on this call.
Yeah, so I was watching Lynn Alden and Luke Groman on a couple of different podcasts, and they seem to be hitting on some liquidity issues, like globally. And I don't know. You guys think there's any anything to that, or is the bull market just over and the bear's coming, bull after?
Yeah, it's a tough question. You think about like just general liquidity and kind of how the economy works. Like where does liquidity get zapped? Like if there's a liquidity crunch, probably the most liquid instruments on the planet, right? Like if you need liquidity, like you go to liquidity, which is like all of the big Mag 7 stocks. It's Bitcoin, which is kind of this. I see it as like the blood of the ecosystem, right? Like the liquidity, the liquid of the entire like economic ecosystem. And then you've got MSTR, which is a function of that. So that's how I see it. And I don't have as much concrete data as like Luke or Lynn, who are following this very closely, but like thinking broadly about like leverage in the ecosystem as well, like the Bitcoin ecosystem. Why did last bear markets why did bear markets of the past happen? They happened because of significant leverage within the system, right? You've got FTX that had loans outstanding significantly greater than the amount of assets that they had. You had these companies that were like there was the credit was building in all of these different systems on not enough assets. And you look at Bitcoin in this ecosystem right now, and I don't have a ton of the on-chain analytics and the data sitting behind like Binance and Coinbase, but from everything that I've seen is like leverage from the ecosystem is pretty much wiped. And you look at the companies that are trading on leverage, you look at strategy, and maybe it'd be helpful to go to the the leverage table that we look at every week. Here, I'll share my screen.
So wait a second, Jeff. I want to back up for a second.
Jump in there.
So you were just in Prague, correct?
Yeah, I was in Prague, Amsterdam, and London.
Okay. When you were in Europe, was it beautiful?
Oh, it was absolutely gorgeous. Prague is one of the most beautiful cities I've ever seen.
Right. And the people there were happy, right? People there well dressed, happy, right?
Yep.
So
same with Amsterdam.
Right.
It felt fake. Like it felt like a fake place.
Right. So I was there previously for another Bitcoin event previously, and I was there, whatever, I don't remember. I was there when I was there with Dan, and I was there, whatever, 3-4 months ago in the summertime. Absolutely beautiful. People are beautiful. Everything is great. So while I'm there, I was there. Tad was there. Tad Smith. He's been on with us before. He was there, and he said sometimes he calls me Grain, sometimes he calls me Mike. He's Grain. You don't get it. I go, what don't I get? Because I said, oh my God, the people are beautiful. The food is great, right? And you're gonna see why this is relevant in a second. He goes, in the European countries, if they were states in the U.S. based upon per capita GDP, they would all rate on the 45th state and below. And I'm like, what? So I looked that all up and I did a whole podcast on this. So the impression is when you go to Europe that everything is awesome there, right? But then the takeaway is when you do research, you find out the per capita GDP compared to US states some of them are less than Mississippi, which is the worst state in the US. Sorry for the people that are Mississippi that I'm picking on them. So what does this have to do with anything? The US has the greatest economy in the world, right? We have the Mag 7 stocks. We have NVIDIA, right? And so we have the best capital markets, right? And so that takeaway is I look at it that we're in the best of the worst. And when I just said nothing changes the numbers I just said. So if we look at this, how's this related to MSTR? They've got almost 650,000 Bitcoins, right? If we think that Bitcoin is the best collateral in the world, my view is, for me, I bet on the company that has the most amount of Bitcoin.
They have a monopoly on the digital capital monopoly. I like how Saylor framed it. He had this recent podcast with Cardone, and like Cardone's a horrible interviewer, so it's like you're gonna have to fast forward it if you want to watch it. But he talks multiple times about Bitcoin being the monopoly, and it is, right. The crypto economy is $3 trillion large. Bitcoin is $2 trillion. Part of that $3 trillion, the next closest is Ethereum. It's like $300 billion. So you've got a monopoly in digital capital. It's trading at 1x revenue, and it's this commodity. And now you've got a company that holds more than 12x of that commodity than any other company on the planet. Any other publicly traded company on the planet. Sorry, there are other large private companies, I guess, and they're offering digital credit instruments to the market, and they're the only company really that can do that at like really significant scale at the moment. Okay, what other company has a balance sheet that's growing faster than that? There isn't one. There isn't a company on the planet that has a net income or a balance sheet that is growing faster than Strategy has grown in the last 5 years. And if you are long Bitcoin and you think Bitcoin's going to 200,000, 500,000, $1 million, there is no other company on the planet that is going to have a balance sheet that is growing faster than Strategies. And that's coming from somebody that works at a company doing the same thing. Right? Like, we have acknowledged that they are the absolute whale, and it's the best idea. That's why we're doing it as well. And yeah, like I'm long. I'm long the entire ecosystem here, and things look good. And I guess from a leverage perspective, like you look around in the industry and you don't see there's not egregious leverage everywhere. Like the capital structure that Strategy has put in place is set to withstand significant drawdown in the price of Bitcoin. Like it could go down to $10,000 and even stay there for a year. They're going to be fine. Everybody's going to be shaken out of positions. We're going to have to rethink what Bitcoin looks like in the future. But that's like the balance sheet is built to withstand those types of things. And now that they've shifted over to this perpetual preferred equity, there is no margin call, there is no liquidation. All the capital that they've raised is permanent capital, and they don't have to pay it back. There's no maturity.
Right. So let me tie this back to what I was saying before, just about why I was talking about Europe. If in Europe, because Stream was launched there, it's in euro denominated. It's denominated in euros. That is a gift to the people of Europe. Now, obviously, if you're in the European Union, it's denominated in your local currency, and it gives you whatever the current rate is on it, 10%. So I think that is awesome for the people there. And like you said, they have a monopoly on the amount of Bitcoin they have in these digital credit products. So what I think what's going on is that once they amass that massive head start, and we've seen this, I've talked about this before. Microsoft thought it was a great idea to come out with the Zune player the day after Apple announced they had shipped 100 million iPods. We're like, what? And it was the same price. It's like, why would I leave something that's the same price that's 4 years late? And that's the same thing that's happening here with strategy. They have a 5-year head start. They have 20 times, well, compared to Mara, they've got whatever, 12 or 12 and a half, 12x the holdings of Mara's Bitcoin. And that's the position that they're in. And they have Michael Saylor with 4.5 million followers that's talking about this. So I think that's where we are. And so the other thing that we say is, the narrative defined the price last year. What was the narrative last year? Well, we don't know who's going to be president. Things could potentially change. Things are looking up. The yen carry trade blew up in August of last. Everybody remember that? That was a disaster, right? Everybody became an expert in the yen carry trade. Guess what? The yen carry trade just blew up 2 days ago again, right? And so now we're back to where we are. It's amazing how it kind of repeated almost 14 months or 15 months apart. And we're back to the same place again. And I think, and we have all the goodness that happened. Do I have to repeat them? But maybe I should, right? So what happened? We repealed SAB 120, or we got SAB 21, Operation Choke Point 2.0, FASB fair value accounting kicked in this year. So you can do mark to market on Bitcoin. Obviously that works both ways. You got Ross Freed, you got the Genius Act, the Clarity Act will probably happen sometimes next year. Right. So you get all this goodness, all this good news, but as of right now, the price is terrible. So I think that, right. And
it's like its narrative is following price now. Or it's like, it's flipped and
it flipped. And
especially for something without earnings. Like if you have a commodity, then yeah.
Last year, yeah. So last year it was all price. Price ran up, and the narrative was like, oh, who's going to win? Are they going to repeal all the nasty stuff I just talked about and do that? So the price ran ahead of it. This time the narrative is miserable. Let's just acknowledge that. And the price is, and then the price follows suit. So I just want to be clear for the people that are listening that we are witnessing this ourselves, and I still have a really large position in MSTR. I do also own a large position in Stretch, so I do think that they will get that peg back up. That's the easiest one for people to see.
Yeah, that'll happen.
They have to arb that back. There's no way that they can leave that low, leave it below the peg price. They have to bring that back up. That's the whole idea for that. And so it's a very new product. What is it? 115 days old?
Yeah, it's like the market will step in. The market will step in once the dividends keep getting paid. Like right now, since MSTR is cratering to 1 mNAV, the market's super worried, like, are the dividends going to get paid below 1 mNAV? And once the market sees that the dividends get paid, even if MSTR trades at a discount, I think those products will revert back up.
Yeah, I was thinking about that today as well. Like, I think there might be some tourists who were, it was below par. So it's like, okay, I can jump in and sell it when it gets to par, but I might as well hold on for that div too. You know what I mean? And then with everything else dropping, you need some dry powder if you want to get some cheap Bitcoin or some cheap strategy or whatever. So it's like, okay, I've been holding some stuff in Stretch. I got my pump from 95 to 100. I got my dividend. So let me go, redeploy some capital. So I think you're right. So the liquidity is going to build over a few months. People are going to see that the dividends continue to get paid, and the tourists will probably move on. And then it's just going to be hodlers. I think these big drops, I think, will fizzle out eventually.
So I personally think that the liquidity in this STRC instrument is going to build tremendously. It's going to take a ton of time, right? Like there's so many traders out there that don't even know this product even exists, right? Like if you're a trader and you're looking to get, 4 or 5% a month, you buy it on the day after the ex-div date, after people sell it, right? Because they know that they're going to get their dividend. And then you know that the company's going to be working to get it back up to 100. You're going to have ARBs that are going to come in and constantly start to trade this. And it's going to be algorithmic, and it's just going to be built into the infrastructure. And because you know that there's going to be pressure to push it back up to 100. And so the pool of liquidity just needs to get larger, right? It's trading $100 million a day, sometimes more, but the common equity is trading what, like $4 billion a day, like more than that, like $15 billion a day. I don't know off the top of my head, but it's like billions and billions and billions of dollars a day. It's like super liquid. Most fixed income instruments are not very liquid. You're taking this fixed income instrument from a market that's not traditionally liquid, and you're putting in an equity wrapper. Now it's tradable as an equity, and people have to wrap their head around it. Okay, it's supposed to be stable, but it's paying me 12%. So how much risk am I taking on? And like, they're using the equity to pay the dividends. Like it's going to take time for people to understand how this thing works. And that's where the alpha is, right? If you're willing to hold this thing for, 2 months, 3 months, there's a really high likelihood it's going to get back to 100. So yeah, I think this checking account narrative is going to develop and evolve over time. Like feeling comfortable having the liquidity to be able to go in and out super quickly and just maintain a peg of 100, I think is going to take some time. But while you wait for that to happen, if you've been sitting here watching what's going on, you get to collect, what is it, 10.5% interest plus any appreciation on the principal if you're buying it below 100. Like, that's a good deal. That's a really good deal. Like, where else are you going to go?
I just threw a link in the chat, and it's for hodlbase.io. Excuse me, I forgot the guy that put this together, but this is we don't get paid for this. And if you go there, it's over $100 million is the average volume on Stretch. You can click into the dashboard, and then it's over $7 billion in volume. So what I find that's awesome about this is the good and bad that goes both ways. You have these, because we have a 24-hour price on Bitcoin, and we know the amount of outs and all the metrics for these companies. Strategy has their own dashboard, and it's updated daily. But if you were to ask me exactly how many NVIDIA GPUs were shipped on a daily basis or hourly basis, I can't tell you that. If you want to figure out how many Tesla cars are shipped on an hourly basis, can't tell you that. Somebody may be flying a drone over, the factory to count all the cars that come out. Maybe that does exist. But this is both the good and the bad. And you were talking about this at the very beginning of the call, Jeff, saying that we live in a very short time frame, low patience society. And we have these dashboards, and these guys make these awesome websites, these awesome dashboards that show us basically near real-time information. Why is that great? You have near real-time information. Why is that bad? You have near real-time information. I mean, it kind of works both. You like, when the price is up, you want real-time information. Yeah. When the price is going down, you're like, can you put a 2-day lag into it? So I think this is the awesome part of where we are today. And this information is verifiable. It's not like this, it's made up. And I think that this is great. So when we talk about the ARB stepping in, that we can see there's enough volume to do this, right? And why do the ARB traders do this? Because they're trading it and they make money on it. That's why they do it. They know that he has a mandate to get the stock to get Stretch back up to $100. If he doesn't do it, then he's going to have to raise the interest rate on it, to get it. It's at 10.5. He'll have to bring it to 10.75, right? It's the last week. It's the VWAP of the last week of the month, correct? Right?
Yeah.
So
somebody asked if where is it? So somebody asked, can institutional capital just sit on it to get them to increase the dividend? I theoretically, yes, but the incentive, there's like very little incentive to do that. You'd be like shorting stretch, which everybody is going to push to 100. Like as you short it, the effective yield goes up, and you're shorting it to get a quarter basis point more a month. Like that would be a very it's not a great trade. There's so many other ways to make money.
Something I realize, but it seems obvious in hindsight. But when you short something like stretch, you have to you owe the dividends because you're borrowing the shares,
you pay the dividend,
and you're selling them, and so you owe those dividends to the person from whom you borrow the shares.
right, there's two problems. You owe those dividends, so if you borrow those shares on the X dividend date, then you have to pay it. The other thing, people are like, I just want to short a stock. If you short any stock, you have to pay an annual percentage rate that is decided by whichever brokerage house you're in order to borrow those shares to short it. It's not free. And so you have to figure out the percentage that you're paying to borrow the shares. Is it going to go down enough in order to justify that trade? Just like when you buy options, you have to pay the premium on it, right? Or for it to make sense, if you think it's going to go up, you have to pay the premium to see if that's going to happen. It's not like these things are free. And people think, oh, they can, can an institution short stretch? Yes. Does it make financial sense? Probably not.
Yeah, it doesn't make it.
Now, do I think that they want to trade it and capture the spread? That is a juicy thing to do. That's the part where they'll trade it back and forth, algorithmic trading to make the spread as it goes from whatever price it was today, 94, as it gets pushed back up to $100. For them, that's a very tight trading range. It's a perpetual pref that functions like a bond, not exact.
Yeah. The incentives are aligned really well. Like the engineering of these products it aligns incentives to be along the credit quality of the instrument, as opposed to the trading that occurred with the convertible bonds. It's the alignment of incentives.
Right. So somebody just asked the question about Misty. So I was thinking about buying Misty last year, and I got a phone call from somebody, and basically the person, I won't leave the person's name out, got a phone call. The person just said, Grain, just read the prospectus. And I was like, oh. So I read the prospectus. Now, the first 35, 40 pages of the prospectus was just boilerplate. I get to like page 40 something, and I was like, oh, this looks terrible. And I did not plug it into AI. I was doing the old fashioned reading it. And then when I read through how it was set up, I'm like, this is not good. And so from my perspective, I had bought shares and then I sold it basically like a day later after I should have done my due diligence in advance, but I didn't. And so with that, once you read that, and so when I knew that Misty was return of capital and the yield, I want to talk about this for a second. The SEC allows the yield to include return of capital in the yield and the trading that it does in order to generate that income. According to the SEC, both of those could be listed as yield. And I don't know what the current yield is on Yield Max. I can look it up right now, but it doesn't matter. Back then, they were saying it was 89% a year, but 80% of it was your own money coming back. And once I read this all, I was like, oh, I don't like this at all. So then when I heard that we thought that the prefs were going to be return on yield, but we did not know in October, I wrote a post on that and I was like, oh, this sounds like Misty all over again. And so I wrote a post on it. And then some people commented a few weeks later when we found out it was return of capital. And when that happened, I was like, initially when I saw this, I wasn't happy about it. But then I thought about stretch, and stretch is designed to maintain a peg, which Misty doesn't. And that was a question that popped up here. So Misty, MSTY, is not pegged to anything. And we've seen this price erosion happen. It's basically dropped to 1/4, I believe, of what it used to be. And it's completely different than stretch. But stretch is only talking about a 10.5% return, right? That's the rate that we see. They're not offering an 89% return. And that's the big difference between stretch and Misty. So those were two different things. And I think that, Yield Max, those products were designed, I guess, for you to be in it for maybe a month or two, but it kind of defeats the purpose.
So
I think for like a year. Yeah. If you just want to hold something and it's
yeah, Misty was actually, there's been several credible studies, because the battle cry for the Misty Bulls is that it's for income, right? But there have been several credible studies that show that even for income, just hodling strategy shares outperforms Misty. British actually tried to disprove that theory, and he misread his own spreadsheet. So he actually proved that case as well, that just, hodling strategy shares. Yeah. Anyway, I did a whole video on that. But yeah, so he, just hodling strategy and peeling off shares over a long period of time actually outperformed Misty. So, yeah.
Yeah, let me chime in real fast on the Misty piece. I just went to the website to look at it. So if you go to the Misty website, look, they designed the product. And this is right on their website. I'm not making this up. The distribution rate is 92.55%. The 30-day SEC yield, you got to love how they call it SEC yield. And there's on distribution rate, there's an asterisk, and it says that and it says right here, the first asterisk on the 92.55%. The most recent distribution on November 19th contains 24.76 return of capital and 75.24% of income, right? And then it talks about the 30-day SEC yield and then the return of capital. Now, the problem is that the price has dropped so much that it does not offset the loss in your principal by giving you these yields. That's in my view. If people love this, then whatever, do your own research and buy it. For me, I don't think the math works.
The AUM has fallen. I think at its peak it was somewhere around like 5.5, maybe 6 billion of AUM, and now it's down at like 2.25, which I think is like bullish for when this does turn back around the other way. You have much less people that are selling covered calls, chopping off the upside systemically with it, which is interesting. Shall we talk 4-year cycles? Somebody brought that up. Did you guys talk about this last week?
Brandon and I focused on it mostly with like macro overlay, and then we talked prefs too. But
so funny. I mean, just in Europe, a lot of people were just bringing up 4-year cycle. They're like, up 4-year cycle, pack it up. I'm selling December. Like, and it's just so crazy, or it's just like they're thinking about just a number of days. Like, it's just a number of days. It's just, I'm going to sell every 4 years, and I'm not like conceptualizing or contextualizing anything about like the architecture of the market or the infrastructure or the regulatory environment or any macro or anything like that. It's just, it was crazy. Like probably 50% of the people I talked to were like 4-year cycle people. And, I guess that's a market, right? If 50% of people think it's one way and 50% of people think it's the other way, we're like right.
I'm really attracted to the 4-year cycle thing. I think because I like patterns. Like, actually, I'm old enough to have played video games in an arcade where I literally had to put quarters into them. And some of my favorite games were like Galaga, Pac-Man, stuff like that. And you could just get into this rhythm where it was like you knew you were going to have to, left a little bit, right, just jogging back and forth. And so when I saw Plan B with the 4-year, stock to flow model, and then I was kind of attracted to the power law a little bit. I just wanted predictability. Like, I wanted to be able to make this make sense. And I couldn't really stay on task because it was like, well, nothing can be guaranteed. But then I thought, well, maybe if this is just in the protocol and the halvings are affecting this. Like maybe this is for real, but it just can't be as predictable as myself and I think a bunch of other people want it to be. So yeah, I think there's got to be a lot of people getting okey doked thinking, yeah, just sell by the end of the year and wait a year and a half, catch the bottom, and jump back in. I think there's got to be some surprises in store.
Well, the typical business cycle is 4 years. Like, which kind of makes sense. You think about the political regimes; they're generally 4 years. Then you get turnover and all these things. But the data is pointing to an extended business cycle, like maybe a 5 or 6 year business cycle. So we might see particularly with tariffs and like how the economy shifted and like how it's designed and structured, the red sweep, et cetera. And so we might see this extended cycle where, maybe 26 is bull, like the entire market, like the entire year. Who knows? But again, I come back to like leverage in the system and thinking about there's like what would be the huge catalyst for a really dramatic bear market when like everything is a tailwind from here really.
Yeah, so I do have one weird conspiracy theory. So I was at the Bitcoin Veteran Summit last week, and I was pretty stoked because there was a 5th generation warfare segment, and there was like some retired Intel guys and some special forces guys. And 5th generation warfare has evolved to the point where every single person on the planet is at war 24/7. We are all under attack. It's everything from the sentiment on social media to, every other thing that can kind of make you pliable and depressed. And you just have to kind of like be on guard for that. And where that kind of led me though is that if we're all under attack all the time, because the fiat system is not trying to let Bitcoin win, then Bitcoin also must be under attack. And it made me think about, is Bitcoin's price suffering from some kind of attack that the fiat system is trying to not go down without a fight? And of course, I'm a little bit biased on this particular front because I've been talking about Bitcoin Core and knots for quite a while. But if I have to imagine what a credible attack on Bitcoin would look like, I would try to infiltrate the people who are developing the code. And back in, was it 2017, we were supposed to get 100K and we only made it to 67. That was right around the time that SegWit, we thought we won the block size wars, but in reality, I'm not really sure that that's the case. And I think maybe that the network has kind of somewhat detected this attack that's been kind of being implemented over many years. The Taproot upgrade made it even worse. And Luke Dasher actually identified that inscriptions hack, but they kind of 1984 Newspeak redefined the terms to make it to make it not a bug. This is a feature, not a bug kind of thing. And so this seems like it's culminating with the V30 drama that we've had recently. And so I'm wondering if like that's maybe why we didn't get 100K 2 cycles ago, and why we're not getting 444 a million this cycle. And the silver lining to that is that we've got a proposal. It was originally called BIP 444. I think the official term for it now is the reduced data temporary soft fork. And if this goes through, I think this will be a self-healing event for Bitcoin. And we might get that fix by like February. So maybe the business cycle turns around in 2026. All the people who are planning to sell for the 4-year cycle are gone. And if the network gets this fix in place, every single time we've overcome a black swan event, we've always pumped, right? Bitcoin comes back better, faster, stronger. And I'm just hopeful that that this spam drama gets resolved and Bitcoin demonstrates its resilience. And I think it is. I think we're demonstrating that we are anti-fragile, and this reaction has caused a lot of passive Bitcoiners to run nodes, start mining, and really kind of pay attention, because I used to think all I had to do was stack sats, but I think there's a little bit more that we're going to have to do. And I don't think it's as big of a conspiracy theory as like flat Earth or lizard people controlling the world from an underground under Antarctic or anything. But what do you guys think about my other delusions?
I think it's interesting to hear your perspective on the state of the network, because that's something we definitely don't talk about. It's like the infrastructure and the code base, the developers, and everything that has to do with Bitcoin. So I appreciate that perspective, and it seems like it makes sense. I mean, pressure on the network from external forces would be detrimental to price and sentiment, and for all the above reasons. I also think there's something to that too, is like this idea that if everyone's selling the 4-year cycle, it is self-perpetuating for a little bit. If everyone's selling, like, that is sell pressure. Like, you can say 100%. Like everyone's bearish. Like, it's that Druckenmiller quote. It's like, everyone wants to be a contrarian investor, but the crowd makes money 80% of the time. They just lose it all the other 20%. So he's like, it actually pays to go with the crowd 80% of the time. He said to be very careful during situations in which there's something bad, much like the AI trade, the NVIDIA trade, even Bitcoin, right? Like the narrative, like all these are pretty structural kind of good long asset trades. You want to be with the crowd there, but then there are times when you don't want to be too euphoric or on the wrong side of it.
So, yeah, so I want to be more precise here on the cycles. The 4-year cycles for Bitcoin seem to coincide with U.S. presidential elections. So you had the 2012 halving, 2016, 2020, 2024 halvings. And by a stroke of luck, it just correspond with U.S. presidential elections. And then in the going thought process was in 2017, and I didn't realize at the time when I got into 2017 that 18 months after the halving, Bitcoin tends to hit its all-time high, and then you go into a crypto winter. Now, in the previous cycles, it was kind of weird because you had Mt. Gox in 2014, and you had a big run-up in 2012, and then that was a major problem for what happened to Mt. Gox in Japan. So I think that each cycle is different. I'm not saying there's a 4-year cycle. What I think is different now that I would say why I think this time is different, and whenever you say that, somebody's like, oh, no, it's not. Now, there is other self-fulfilling prophecies, sure. But back in 2020, if you look back, to the olden days, 2020, right now the total federal deficit is $38 trillion with approval to go to 41 trillion. 2020, it was 23.5 trillion. We currently have $1 trillion in interest payments each year. 2020, it was 345 billion. So that's almost tripled. If you're just paying the interest on the $38 trillion in debt, it never gets any lower. That's not changing. And then debt to GDP was 102%, and currently it's 125%. None of that is going to get fixed. And the tariffs, if you have $200 billion coming in tariffs and you're going to give back $2,000 to whatever, 100 million people, then that ended up wiping out all of the money that came in from the tariffs. So why do I think that this cycle is different? It's because structurally and macroeconomically, that's the amount of debt is different in the US. Though you cannot refute those numbers. And so 2017, we weren't talking about, these numbers being that high. So what I think is going on is that we also, in January, it's going to be the 2-year anniversary of the spot Bitcoin ETFs. And they have, you guys could all look it up. There's 2.5 million Bitcoins inside the spot Bitcoin ETFs and the Bitcoin treasury companies, right? That's 1 million more than are on the exchanges. So I just think that do we have some whales selling because the price is close to 100 grand? Probably. Do we have in-kind that's happening that you could not do? The in-kind transfers into spot Bitcoin ETFs was not possible until maybe 3 months ago. And so now they could do this in-kind transfer for their Bitcoin into a spot Bitcoin ETF. Why would they do that? Because then they could borrow against it. And it's easier to borrow. Why is it easier to borrow against a spot Bitcoin ETF? And the reason why is because in November of last year, there became an option market on IBIT that launched sometime around the third week in November. That did not exist, right? So what do? They do a put call collar on it, and they allow you to borrow against it, right? The people that are listening probably unaware that that's possible to happen. But if you have large sums of money, you could do that with a brokerage to put that in place. That did not exist in the previous cycles. The other thing, I want to give some hopium to people, what's going on here, right? You had 2021 Bitcoin peaks, right? It happens right around Thanksgiving. Then what proceeds to happen, why I think in that cycle we didn't hit $100,000, people are buying Bored Ape NFTs. That money bleeds out of buying Bitcoin, and there was no spot Bitcoin ETF. MSTR was only basically into this for a year, right? Think about it. People are buying Bored Ape NFTs for this huge amounts of money. The Beeple, NFT that came out, all these large ETH purchases, and people are like, oh my God, ETH ran up higher as a percentage in that cycle. So that bled off the buying pressure on Bitcoin. Then what happened after it? You have two things that happen. FTX blows up with SBF, Sam Bankman-Fried, right? And you have the Terra Luna collapse combined with 3AC, right? That hypothecated all the Bitcoins for BlockFi, Celsius, all the lending. And then basically the Winklevoss twins got duped with lending to 3AC. Kyle Davies and his other buddy disappears. And we have that whole mess that happens. What's different now? You have spot Bitcoin ETFs, like I just said, all the goodness that I said before. And so I think this time is different. And Bitcoin's a $2 trillion asset class. So do I think now sometimes it trades like a tech stock? Yeah.
Yeah, just what you mentioned where people are, we're pouring money into NFTs. People are making that same argument now and blaming treasury companies and saying, oh, that was money that should have went straight to Bitcoin. And, they're kind of like,
okay, so you know what?
They're tap dancing and yeah.
Sure. Is that true that's what happened? Yes. People, instead of buying Bitcoin, they put into Bitcoin treasury companies, right? Do I think that you had more transparency to understand what's going on in a Bitcoin treasury company? Yes. Do I think, look, I lost a bunch of money on Metaplan. I'm the first, I did my tax loss harvesting 2 months ago on that trade. I don't want to say how much I lost on it, but you have to do your own research, make your decision, live by those decisions, and then you decide what you want to do with it. Do you want to hold it and wait till it comes up? And I was like, no, I'd rather deploy the capital that I have left from that, what I thought was a great investment, and put it into something else, which I did. And so you have to make those decisions in life, right?
Yeah, I think there's a clear distinction. Some people just group all the treasury companies in as shit coins, but I think clearly there are red flags for shit coins. Like, if it's not proof of work, if it's centralized, if they had a pre-mine, I think there's one more. You're dealing with a scam altcoin. But with treasury companies, we've got frickin' SEC filings, for God's sake. Centralized.
They're a pain in the ass.
Yeah,
they're a huge pain in the ass.
There's not going to be any filings with these altcoins, right? Those are just rug pull, pump and dump. And if you think that the future doesn't have Bitcoin treasury companies in it, then you don't think companies exist in the future. Clearly companies will exist, and every single person and every single company will own Bitcoin. So I don't think it does any good to complain now that people bought Bitcoin treasury companies and then those companies bought Bitcoin. That's just living in the future. That's just what everyone's going to be doing 50 years from now.
Yeah. And by the way, look, gold did really well this year. Okay, great. I am unaware, right, of any companies that have ever said or have a dashboard to say, oh, look at how much gold we bought on our balance sheet. right?
I'm a
If
gold
gold
treasury
is
company. Yeah.
right, you know, besides maybe a gold miner, I am not aware, and I don't, you know, talking about this, I don't know if there's a gold bug group that's like, oh, we've got a CEO with 4.5 million followers that thinks that buying gold on the balance sheet is great. What do you have here, Jeff?
Yeah, I think this is a good time to whip this out. We were talking about companies holding Bitcoin. Solei, you mind bringing us back up on just changing the view so we're all here?
Yep, I gotcha.
But right, so Saylor had this quote. Saylor had this quote this week, and it was on Fox Business. He said, "As long as Bitcoin keeps going up 1.25% a year, the company can pay the dividend forever." And I loved it. I was like, "Oh my god, I want to do the math." Right, so I did the math, and this is what the math looks like over here on the left hand side. And this is just really rough, or like basic. I have no idea what Saylor is looking at and exactly how he's calculating it, but and I figured we could go through some spreadsheet stuff because you could think about how long this company is going to be around, even if you think the Bitcoin CAGR is 1.27%.
I'm excited for this because that just doesn't make any sense to me right from the beginning. I'm like, wait, how is that possible?
Yeah.
So show us this math. I got to see this.
Wait, but hold on a second here, Jeff. What you did on this chart on row 18, you've got a line, and then it jumps to row 104, and those are years.
Those are years, yeah.
Right, yeah. So I've never seen this chart before, but what you're showing here is that the Bitcoin declines at what? You said 1.25% in the formula? 1.27% CAGR. Oh, it goes up by 1.27. Right. And then he would sell that 1.27% to pay it. And you're showing there that he still has 177,000 row 113. He still has 177,000 Bitcoins, or right there.
Yeah.
That's Bitcoin held. And then the net Bitcoins, your last column, row I.
Mm-hmm.
And so, folks, look, if somebody creates an Excel spreadsheet and you've never seen it before, but you can then speak to what it says. And Jeff, if I got it wrong, chime in.
No, you nailed it.
You're showing the loss between column D and I is the 1.27%. Correct?
Not quite. And
okay,
I'll
ahead.
I'll walk through it. So you've got Bitcoin held at the beginning of the period, right? So you've got 649, almost 650,000 Bitcoin. Bitcoin price at 92,500. And that's about where we're at right now. So 60 billion worth of assets. And then I just assumed the $750 million dividend payment just comes off the top, right? So that's just $750 million just paid out once annually to make the math simple and just make it so I didn't have a 10,000 rows. And so the net assets is just, okay, what if I sold that amount of Bitcoin to pay the dividends? And here's how much net BTC in fiat dollars you have afterwards. That's column H. And then what is that in the value of Bitcoin, column I? That's just taking the assets divided by the Bitcoin price in column E. So you get to 641,000 Bitcoin. And so that number starts over at the next row. So you start with 641,762 and you go through the same math. But in each year, so starting in 2025, next year, 2026, the price of Bitcoin goes up 1.27%. That's what I've got outlined here. So next year, 2026, the price of Bitcoin goes to 93,675. 27, 94,864. And what you'll see is if you run the math here, and I'm just going to scroll down. So actually, hold on. Let's fix the year column here so you can see. View, freeze panes. Cool. Okay. So and you can look at this net BTC column to see if you run out of Bitcoin. So you can see you keep going down here, net BTC column. You're never running out of Bitcoin. You're going down, and eventually the price of Bitcoin gets so high that your dividend payment trends to zero.
Mm-hmm.
And that's, what are we, 950 years in, the year 2,973.
And you just gave up?
I stopped because I guess I could just drag this down further if I wanted to. But and I think the most fascinating thing is even if you take, maybe I'll just drop it to 1.25, what Saylor said. What do you get down there? I think with the 1.25, I've got it running out in the year 2390, but that's probably just we're talking very small, very small delta there.
But
the really
interesting payments get paid. Yeah.
What the dividends get paid.
Dividends get paid even if Bitcoin doesn't really compound. That's effectively the over collateralization, which is not present in any other financial institution. During the 2008 financial crisis, Lehman Brothers had $280 billion worth of outstanding liabilities and 260 billion worth of outstanding liabilities and 280 billion worth of assets. And so they had so that's 20 billion worth of shareholder equity. When those assets were repriced down just 4%, all of the assets technically owned by the shareholders and the debt holders were completely wiped out. So in that scenario, the preferred stocks went to zero, both the cumulative and non-cumulative preferred stocks went to zero. And in this case, that's not the case. For the shareholder equity and the debt liabilities, effectively the prefs and the converts, to have no claim over the Bitcoin would need to fall by 5x or roughly down to like 15K and stay there. And then, and stay there. It's not an actual professional liability. And then they'd have to face bankruptcy. So a bankruptcy proceeding. So the 2008 financial crisis is much, much, much different for those cumulative preferred stocks. And I think that's a lot of the fear in people's minds with these preferreds, is because really the entire precedent for these stocks are from financial institutions and then also utilities companies. But there was a huge, huge problem with these, both cumulative and non-cumulative preferred stocks going belly up during the financial crisis. But you have to understand those companies were levered 21 to 1 as opposed to 1.2 to 1 on debt that actually was a mark to market on assets that weren't marked to market every day, like Bitcoin.
Right. And you can see like the liquidity in Bitcoin. You can see the risk. You can calculate the risk 24/7, 365. It's so incredibly transparent compared to anything that's ever existed before. And just in this test, right, the Bitcoin CAGR of 1.25% in the year 21-22, you're looking at a Bitcoin price of $300,000. Right, we've got people calling for $444,000 in 2025. Right? I know people are bulled up for $1 million in 2032. This is an incredibly bearish scenario, and they're still paying their dividends into perpetuity. And and we talked about this on the hurdle rate earlier this week, and I think this is such a good point that Matt brought up. Right, let's say Bitcoin breaks for like something, so we have some tail event that breaks Bitcoin. It's not like institutional capital is immediately going to go running for the next crypto, right? Like they're not going to go run for Ethereum. If something breaks Bitcoin, it likely is breaking most cryptographic currencies. It's not like they're going to instantly go run to like Zcash. Because, Bitcoin broke, let me go run to Zcash. Not going to happen, right? They're going to shift to a completely different system. Maybe it's gold. Maybe it's something so bad we want to shift to guns and whiskey and cigarettes.
Hey, Jeff, you were just there in Prague when that person made the comment that Bitcoin is a hedge against monetary inflation, debasement, and then Zcash is a hedge for Bitcoin. Were you in the audience when he said that?
I was like, I did a major double take. Yeah, it was. And then I walked. I was like, what the fuck? And then I walked away. I was like, this is a joke. Like this is a total joke.
Right. And look, I think that when you do these look, if somebody doesn't like Jeff's calculations, okay, go make your own calculations and figure it out for do your own assumptions, plug it in there and do the math. And I think, thank you for doing this. And that's the part, somebody said Saylor's never selling. No, he's not. Do I think that he could borrow, 1 to 2 or 5% that he needs each year in order to pay to pay these dividends? Yeah, I think he can borrow pretty easily. There's an investment bank that's going to give him the money in order for him to sell it. And I get that the other part is that the big acquisition of Bitcoin is kind of done. I want to go back to something that this comes up all the time. When he announced a $21 billion plan in Q4, it was a 3-year plan, and he executed most of it in 5 weeks, right? That was a huge amount of shares that went out in basically a very short period of time.
It was a record. It was a record. It was like most equity issued ever.
Yeah, it was huge. And he acquired what, approximately 150,000 Bitcoins, right?
Yeah, it might have
So
been more. As long as like 250. Yeah.
Right. So I think that was a one-time event. And in my view, unfortunately for the stock did recover pretty well. But I think what we're all trying to believe here is that look, Bitcoin will go, if you don't believe in Bitcoin, right, then don't buy Bitcoin. If you don't believe in Bitcoin, there's no reason to buy MSTR, because why would you have the faith that the prefs are going to get paid? You're going to be the person like, well, they'll go bankrupt and I'm not going to get paid. So then you wouldn't buy it. So my takeaway is, all the macro indicators that I said, then just go take your whatever, 2, 3, 4%. Right.
Yeah.
So we keep on getting these different questions coming up. Do you guys want to go through some of these questions?
There was one more thing I wanted to hit on, and Mike, you kind of hit on it there for a second. And I wanted to talk through like the concept of trying to convince somebody to lend dollars to people that hold Bitcoin relative to the pref. So when I left the reinsurance world, I jumped into Bitcoin headfirst, and I told myself, like, I need some time to figure out what's the deal with the market. And I was going to events, right? I saw you guys in February and April, where I was going to all of the events. I was talking to as many people as humanly possible to figure out, like, where's the opportunity in this market? Right? I know what strategy's doing. I know what strategy's doing really well, but like, what's everybody else doing? And it became very apparent that a lot of people were trying to build these lending platforms that people can take their existing Bitcoin and go get loans on their existing Bitcoin using Bitcoin as collateral, which I think is a necessary part of like an economy and like how this whole system is going to work. But then I started thinking about the other side of the trade. Like, how do I go sell that to somebody? Right? If I need to go sell some like institutional capital and I need them to lend me dollars backed by Bitcoin, I've got to go convince somebody with a lot of money that they need to take their opportunity cost of capital and lend it to this person for 12% return, something that's like kind of lucrative enough for both sides to take the trade. And in order to convince them to do that, they need to feel comfortable about Bitcoin, right? Like, just fundamentally, you need to feel comfortable about Bitcoin that it's not going to like disappear tomorrow and it's not going to go to zero. Okay, so if you got to go convince institutional capital to get comfortable about Bitcoin, why wouldn't they just go buy Bitcoin instead of lending to some Yahoo for 12%, collateralized by 2x the Bitcoin, and take on some like counterparty risk of some, like leverage machine in the cog, right? And so you've got that's one side. And now the really neat innovation here with this digital credit and where this is shifting is, instead of going to convince sophisticated institutional capital to get comfortable with Bitcoin, in which they would rather just buy Bitcoin themselves, you can convince people that are Bitcoin curious to not even have to believe in Bitcoin and buy a digital credit instrument to get the benefits of Bitcoin. That pool of people that could potentially be Bitcoin curious is significantly larger than the number of people that would possibly potentially lend to Bitcoin holders and not buy Bitcoin themselves. If that makes sense.
Like a marketing funnel?
Yeah, just like
to Bitcoin.
I'm just thinking as a salesman, right? Like, I'm a salesman. And like, which would I rather go sell? Would I rather go sell a digital credit product? Or would I rather go try to convince somebody to lend dollars to a Bitcoiner? Right?
Mm-hmm.
Like, a lot easier to go sell the digital credit product to a bunch of people that may be Bitcoin curious, as opposed to trying to go convince somebody about some like infrastructure, teach them about the computer like code and like how it works and the liquidity. And like, once you convince somebody to underwrite the entirety of Bitcoin to feel comfortable giving that 12% loan, they would have already bought Bitcoin themselves. They're like, why don't I just buy the Bitcoin? Like, why am I going to do it? Like, why am I going to lend you dollars for 12% and take on all this fucking weird risk when if I feel comfortable with it, why don't just buy some Bitcoin?
Yeah. The amount of effort that it would take to orange pill them, they'll just won't be interested in loaning the damn thing at that point.
That's it. Whereas the digital, like you got to take 5,000 hours to convince somebody to take that loan. Right. And then on the other side, like, what's it take? 10 hours, maybe 5 hours of talking to somebody. And
you can't do it in 20 minutes in the sauna. I know that from personal experience.
you probably need a couple rounds in the sauna.
Wait, guys, look, I posted this. I tell people, somebody says, explain to me about Bitcoin. I'm like, sure, I'll explain to you Bitcoin. You ready? CPI, Consumer Price Index, the US number is 3.0%. The reaction usually is it's probably higher than that. I'm like, okay, just say it's 3.5. It's way higher. Just say 3.5. I'm like, the M2 money printer is 6.5% a year. That's what it is over the past 25 years. You all agree to that? What's that? Well, we have a $2 trillion budget shortfall, so we have to print the money to balance the budget because there's a deficit, $2 trillion a year. It's 6.5% over the past 25 years. I got a lot of kickback for this. I add those two together. And the reason why I add them together, CPI measures supply chain problem, not the money printer. What's a supply chain problem? All the chickens get sick. There's no eggs. The price of eggs double overnight. They didn't double this money supply overnight, but there was a supply chain problem. So people are like, okay, I get what you're saying. Okay, what does that mean? At 10%, 3.5 plus 6.5 is 10%. The rule of 72 says your buying power gets cut in half every 7.2 years. I'm done. Your house did not double in price. It takes you twice as much money to buy the same house every 7.2 years. You don't like 10%, make it 7.2%. That means every 10 years, your buying power gets cut in half. The young people that are watching this that are under the age of 30 know this implicitly. They cannot save money fast enough to put down a down payment to buy a house. That's it. And if somebody tells me, who's Satoshi Nakamoto? Don't care. As long as the supply stays at 21 million and that it's fixed and 95% of it is mined already, that's all I need to know.
Yeah.
There's your Bitcoin pitch. If they're like, oh, I never thought about constant dollars. I'm like, you never heard about inflation? That's it. That's my whole pitch on Bitcoin. You don't get it? Why do I add those two numbers together? One is monetary debasement and one consumer price index. Go look that up. It's consumed goods.
Yeah.
I'm happy. So
you got me convinced, Mike. I'm going to go buy some Bitcoin.
I completely agree with you. And I did a podcast in London this last week, and it was the reinsurance podcast. I think it's going to come out in like a week. If it gets over 5,000 views, it will be the most watched reinsurance podcast in history. So I think we got a good chance of beating that there. But anyway, this topic came up. Basically, I was talking to two reinsurance guys, and they let me come in and talk about Bitcoin risk and reinsurance. So I did talk a little bit about like what is Bitcoin, and try to like get to an audience and try to explain it quickly. And I came up with this new way of explaining it. I think it's decent. And I think appeals to some of the boomers, Mike. And maybe this is worth a try.
Right. Hold on a second. But just be clear, I'm Gen X.
Gen X.
I might have gray hair, but I'm Gen X. Go ahead.
He meant when you're talking to boomers.
When you're talking to the boomers. When you're talking to your wealthy friends.
My boomer friends. Thanks.
All of your wealthy friends have bought homes. Right? All of them have bought homes. Right. And so I explained this on the podcast as Bitcoin is a monetary ledger. Okay. When you buy a home, there's a monetary ledger that's held at the county. When your house gets recorded, there's when you buy it, there's a Karen that's sitting behind there getting paid minimum wage to go record your home. And it takes like a week. It's stupid. Like you do the whole like negotiation process. It's crazy. And then it takes like a week to record. This is like to write your name down in some documents and record them at the county. That's a monetary ledger. Imagine if you could do that in 10 minutes with computers and have finality. No Karens, no anything. You've got a computer ecosystem around the globe that's able to do that. And I like in communication with them, like it kind of worked. Like I know the guys that I was talking to have bought homes, and like everybody can wrap their head around this like real estate concept, like monetary ledger concept. And I hope it hits. And so I'm gonna try to tease that one out a little bit more with people I know that have bought homes but are like can't really grab Bitcoin really.
Yeah, when I bought my house, it was 200 Bitcoin, I think, and now it's like 80 or something.
Yeah. So, you know, Jeff, that's a great example, but I'm going to tie back the house analogy back to the prefs. Once you own it, and look, there are people that are like, oh, you should rent forever because whatever that down payment is, you can invest that and that'll grow faster than the value of your house. The reason why you buy a house, if you get married, maybe you're not married, you just have kids and the kids have to go to school, you'd rather own a place because then the school district is a known event and to have stability to raise a family. So that's a reason why people buy homes. Okay. If you're single and you're not married, don't have kids, you know what? Heck, and you want to move around, don't buy a place. But how is this related to prefs? Once your house is paid off, you don't have a refinance event. The only thing you have to pay is maintenance, utilities, and your taxes on it. And taxes in California about 1% of the purchase price, and they can only go up, I think, by like 2% a year. So what happens is that you never have this refinance risk that happens. And so that's the permanent capital that people talk about when you sell equity. It's permanent capital. What's a pref? There's no refinance that ever happens. Right. Once your house is owned, once you own your house outright, somebody's like, oh, the interest rates went to 7-8%. You're like, don't care. And then somebody be like, you know, you fucking asshole boomer because you bought your house, you know, for 1/10 the price 30 years ago. And everybody's like, screw you, because the other generation, because it was debased. And they're like, oh, I don't know why it's harder for you. And I'm like, I don't know why you're so fucking stupid. Sorry for swearing. But if
no, Mike Solei is getting roasted in the comments.
Because I can't math. I said my house is worth 80 Bitcoin. It's eight Bitcoin.
I love it.
Yeah. So with that said, guys, I mean, look, I have zero patience. Why do I have patience? Why don't I have patience? What's going to happen is at some point in the future, right? Bitcoin's going to rip higher. And when I mean rip higher, it's not going to retake the all-time high by $1,000, right? Go from 25,000 to 26. We're going to see Bitcoin go to 125, 150, 200,000. Somebody said, is this in 30, 60, 90 days? I don't know the time frame of it. But somebody also asked, or somebody said, if Bitcoin retakes an all-time high next year, which I think it will, that means the 4-year cycle is dead. That means Bitcoin has crossed over into a legitimate monetary instrument, which I believe is true. And when that happens next year, as Jeff, you say, the bewilderment will happen and it rips higher and MSTR common stock goes higher. It's not that I'm a fanboy. I think that's all going to happen. I think the prefs are going to be successful. And if somebody's like, how did you know? And I'm like, you know what? I had conviction. And I will have zero patience because I've been in this for 8 years. And it's like, if you had the conviction to do it and you could stomach the volatility, then you would reap those rewards. But if you don't have the stomach, the volatility, then you don't reap the rewards.
Yeah. I think one of the crazy things in thinking about that is like, where's the rest of the market? Right. If we do think Bitcoin rips in 26 or late 25, I don't know, we still got a month and a half left. What's the rest of the market doing? And how do you rationalize valuations greater than they are right now? Like what you got to think about where everything else is. Like, and Grain, you even brought this up a little bit earlier, like white collar people are losing their jobs because of AI. Like I'm seeing it happen all over LinkedIn. My wife's seeing it in the recruiting world. And like, okay, the government debt is getting larger. Tax revenues are decreasing, right? Because you've got all these like really high value people that are no longer needed at their jobs because AI just literally got rid of it. So like that's an equation that is very difficult to unsee. And what's everything else look like? Like everybody,
I think everything else is higher. Like if you expect a Bitcoin bear market in 26, then like historically you would be betting on the S&P being down in 2026.
Highly correlated. Yeah.
But it looks like the way things, I mean, PMIs have been depressed. So that's essentially, purchasing managers index. So it's a diffusion index of whether or not the manufacturing industry in the US is expanding or contracting. It's been in contractionary territory for the past 2 years. There's no reason why the AI capex won't flow over into just general small cap business, plus the increasing profit margins as a result of the layoffs in directly related to AI. There's no reason I think why the S&P would be down next year, especially into a rate cutting cycle. So if you believe S&P is going to be up, then there's no reason Bitcoin won't have a positive year as well.
Yeah, let me chime. Look, next year is an election year for midterms. If we believe, look, there's a couple things. People will love conspiracy theories that there's a group of people that control everything.
You talking to me?
I'm just talking just in general. I'm just not you. I mean, Dan, did you not only write a paper saying that so when is Powell out of his job? May?
Yeah, it's spring.
Right. So he's out, right? We have an election coming up. What do we always believe? Who's ever running the Fed, if they do a rate cut, that's the conspiracy saying that the Fed wanted that guy to get, because if there's a rate cut, it forces the market, it allows the market to run up because it's cheaper to borrow money. So if you continue to have rate cuts next year, people are going to be like, oh, Trump put his guy Mirren, into running the Fed in June. Let's say he gets confirmed in June or July, and they cut rates. Like, oh, you see, that's exactly what happened. His guy got in, they cut the rates, and then Trump re-wins the election because the stock market ripped higher. And then, you'll hear the narrative. All these crypto bros got rich on Bitcoin and shit coins. And they'll be like, God, this. And I'm like, well, you can either go with the narrative, or you could sit there and be like, well, AI just took my job. These crypto guys are getting rich. I'm just speaking figuratively. And I'm investing in a 2040 fund that's made up of 4,000 different stocks. It has a blended average return of 8%. And I don't know why I can't get ahead, because this guy Grain of Salt just said 10 minutes ago, you have to add M2 plus CPI at 10%. So if your fund's growing at 8% because there's 5,000 stocks in it, you're not beating the degradation of the buying power of money. Did I go too fast?
No, very good point.
No, that's it. That's
I'm actually reading Kruger's book right now. What is it? Bitcoin 1 million. Fantastic read. And it synthesizes this all very, very well, talking about, and you look at, I know Grant and I have been doing a lot of research on the equal weight S&P relative to the overall S&P index weighted with the Mag 7. And, and that once strategies in the S&P, this will help as well. It'll be Bitcoin exposure injected into the S&P, but it doesn't matter. Like the S&P 493 are a drag on portfolios, and they have been for 10 years or 15 years at this point. So you're not making any money. You're just not. And it's only going to get worse as those businesses get disrupted by AI. There's going to be winners in the private markets. I also think this idea that public markets is where all the money is going to be is also a fallacy. I mean, tokenization, yeah, but like all the money we've been seeing generated in AI, a lot of it, aside from NVIDIA and Mag 7, have been generated in the private markets. But then what happens to that money once it's generated in the private markets? Like it gets floated around, but then those businesses get pushed, like their margin erodes, their competitive edge erodes because of AI. So I think there's going to be a lot of private market shenanigans. Public markets are going to be very, very much less appealing than they already are if any sort of multiple compression happens in the Mag 7.
The private, like where the private market interaction, like where does it go public, is liquidity. Like, do you want or need liquidity? Because private markets are great as long as everything's cooking. But if you need liquidity, the best way to do that is in public markets.
That makes sense.
Right.
Well,
So
I think the tokenization of private markets is going to be like the next frontier, somewhat.
Yeah, that can absolutely. You just kind of get rid of the SEC, maybe. It goes global.
Guys, I'm going to jump off.
You're gonna jump off. Thanks, Dan. I'm going to jump off pretty quick also. And look, what I think is going to happen, and what's different now in the public markets is that these companies stay private for really long. They have much higher market caps when they go live, and then what happens is they could have a really good IPO launch, and then 6 months later there's a lockup that happens. It drifts lower, and then it goes up eventually again. And we've seen this happen with it happened in the poster child for this was the Facebook IPO. There was lawsuits all about this. They tried to do this price matching. I don't believe it was a Dutch auction for Facebook when it went IPO, but basically a year later it traded down really far. But then Facebook, obviously, which is now called Meta, rips way higher, and it is this massive part of the Mag 7. But I think what's happening now is these markets are different. And what I would tell to everybody is that, and it goes back to what you said, Jeff, the narrative changes now probably less than yearly. Every 9 months, you're like, oh, I thought it was like this. You're like, well, if you're paying attention, things are different. And I'm looking at the valuation on AI, and I think the valuation is super high, right? I think it's but then when you look at Nvidia, I believe it's trading at 35 or 40x forward PE. That multiple is not that high. And my view is I think that could run a lot longer. Not financial advice, not saying it, but I think that, where that's going and what its track record is, that's pretty awesome. But if you look back, Nvidia has had some major pullbacks, including this year. And so what are we going to wrap up with? Because I could talk about that if it's interesting.
Yeah, this concept of a multiple, I think, is always a good topic. But and I'm just going to share my screen one more time because I think this is interesting context on like the 1x mNAV bears.
Oh, try again. Try to share again.
Oh yeah, give me.
I
a
misclicked.
There we go. Screen share. There it is. Okay. As of 12/30/2023, 1x mNAV for MSTR was $52, $52 a share. As of 10/7/2025, the 1x mNAV was $271. As of today, 1x mNAV is around $208. This is just pure, not even taking into consideration the debt. This is just a multiple over the Bitcoin. If Bitcoin were to go back to its previous all-time high at $126,000, the 1x mNAV is $285 for MSTR. If Bitcoin were to go to 150,000, the 1x mNAV goes to $339. So just keep that in the back of your mind of like how quickly some of this stuff can shift. Like if Bitcoin starts moving the other direction and it moves 50% in 2-3 weeks, like we've seen it do in the past, then you've also got some of this 1x mNAV concept in play here where it's going to flip back and go the other direction. But the real thing is here, the 1x mNAV, let's just go back to where we're at today and let's just say 92,500. Right. Shares outstanding have increased 87% from 12/30/23. They've gone from 153,368, so 153 million to 287 million. Shares have increased 87%. Yet the 1x mNAV has increased 302%.
Mm-hmm.
And the BTC price has increased 119%. Right. So if you think it's always going to trend to 1x mNAV, it's like, well, 1x mNAV is moving forward with or without you, right? Like 1x mNAV is marching up and to the right. Like that's what people don't get here. This is collateral. Like the strategy is leveraging their balance sheet as collateral, and they're getting more Bitcoin to put on their balance sheet. Yeah, they're doing it with preferred equity now as opposed to convertible debt. This concept of this new FUD concept of double counting has come up as like, oh, Bitcoin per share metric isn't right because you got to count the preferred equity. Well, it's like, okay, Bitcoin per common share. How about that? Let's use Bitcoin per common share, because in the event that there's a liquidation, like the equity is worthless. Like in the event that Bitcoin crashes and goes to $10,000 and stays there for 5 years, the equity is worthless. Bitcoin's probably worthless at that point. And that would be a liquidation scenario for strategy. Like they have no maturity. Like this debt isn't callable. The perpetual preferred equity is not callable. So do I think there's double counting? No. Like I see Bitcoin per common share, like all of that excess, we're talking about excess return and excess risk. All of that excess return and excess risk is delivered to the common stock equity shareholder. And all of that instrument, the new perpetual preferred equity instrument that you're providing the market, is that lower volatility product. Like you're providing basically someone Bitcoin exposure with volatility insurance on it. Like that's what Stretch is. Stretch is Bitcoin exposure, but you're paying for volatility insurance. Like that's all it is, right? You got no upside, you got no downside. You've got like the insurance policy, like that excess upside that you're giving up gives you that low volatility. So all of that additional return and risk gets delivered to the common stock shareholder. So do I think there's a double counting problem? No, I don't think that's a thing at all. I think anybody thinking about or spending too much time focusing on liquidation preferences is out of their mind. And I think it's pretty easy calculus, honestly.
The hilarious part to me, when people want to say that strategy or the Bitcoin treasury companies that operate this way, they're trending towards 1x mNAV. You know what else trades at 1x mNAV? Freaking Bitcoin.
You just buy Bitcoin. It's easy.
But the thing is, any Bitcoiner understands that the way that you beat Bitcoin is to borrow money to buy more Bitcoin. So clearly, you are amplifying your Bitcoin exposure by leveraging. So, like, how do they forget that when all of a sudden it's a treasury company doing the exact same thing?
I think these are FUD narratives that are spread by people that are short the stock, and they're picked up by, probably mid-curve IQ that know just enough to get themselves into danger here and confuse themselves in their game theory.
So wait. So yeah. So let's go back to the simple math again. Anybody that you buy a house, for simple math, right? You buy the house, you put down 20%. That means you have 5-to-1 leverage on it. When you go to buy that house, right? You don't have provided you put down 20%, you don't have a margin call provision in your loan. And the reason why they can do that, because housing was supposed to grow at whatever, 1 to 5% a year, right?
Can you imagine if there was margin calls on
Could you imagine?
Holy
right.
fuck.
And the only way there
God.
is that if you don't pay on the loan, which happened in the 08 and 09 financial crisis, was horrible, because those adjustable rate loans reset, they weren't able to refinance. Cue the story back about the preferreds. There is no refinance risk because they're permanent capital. So I hear that people talk about this and they're like, I don't think you understand the terms. And they're like, we've never heard this before from somebody. And I'm like, I can't speak to you. And so anybody that buys an ARM, an adjustable rate mortgage, understands that at some point it's going, it's a 5-in-1 loan. After the first 5 years, it can reset every year, or 5-in-2, it resets every 2 years. And so I don't think they understand the terms. And so from that perspective, you take 5-to-1 leverage on a house, right? Because you put down 20%. So you put down $100,000 on a $500,000 house. That's your 5-to-1 leverage. And you're hoping and you're believing that if the house goes up by 7.2% per year, just to use easy numbers, rule of 72, that means the house doubles in 10 years. Right? And if it goes up at 7.2%, it goes up 50%, right, in 5 years. Right? That's kind of what exactly happened from 2020 to now. Many houses in great areas went up. Now, somebody's going to say, well, in my neighborhood, they all bought and they were going to do Airbnbs that wasn't allowed and they lost. Well, that was a regulatory change, right? So I think the takeaway is know what you're buying, know what the area is, and buy for the right reasons. And I would never buy a stock based upon, oh, I think it's going to go bankrupt. That's me. I don't know what anybody... I'm like, oh, I'm thinking about buying the stock, but they could go bankrupt in 2 years. So I'm going to buy it now because I think it's a good, I would just never buy the stock.
That's crazy.
I would just never buy the
That's
stock.
Crazy.
Just like I wouldn't buy the house, right? If I think that the house is not going to go up in value.
I think I responded to Josh with this. It's like not buying an insurance company stock. When like because you think that the Yellowstone caldera is going to explode, and the people that have insurance policies have a senior claim on the balance sheet. It's like, well, if the Yellowstone caldera blows, like half of the US is dead. Right? Like, we have bigger issues, and like then your equity of this insurance company stock that you held, right? It's like the probability, there's a misalignment of probabilistic scenarios, and I think people are having a really hard time assigning probabilities to these types of events, and like seeing them in their head. Like I see the world through probability, so it's kind of easy for me to kind of like sort and like assign a framework, at least for myself. But to me, the fear that people have, and then it's perpetuating on X, it seems like an incredibly low probability tail scenario that wipes out Bitcoin. Which if if it wipes out Bitcoin, Bitcoin holders are also in a really bad spot.
Yeah, I'll wrap up with this.
You know?
Right. So Jeff, I agree with what you just said there. Look, back in the olden days of 2017, what happened with Bitcoin? They were, it was the block size wars. They wanted to change that. This was going on. And every time a new BIP format came out, it was like, if it didn't go the way the narrative was going, Bitcoin would drop 10, 20, 30% in price. You had this massive volatility swings. Then you had China banning Bitcoin, I don't know, 3 times, 4 times in the year. They keep on banning Bitcoin. So this would all happen. The volatility was absolutely absurd. And so now you're always going to have that same volatility get shaken out. And if you get shaken out, then so be it. But, at some point in the future, look, I've been in this now for 8 years. Would I have rather would just be all smoothing straight up? Sure, but it just doesn't work like that. And so the takeaway is, you buy a house and hopefully everything goes right. It doesn't matter where you buy the house. There's always an issue in some part of the country. You buy it in Florida, there's hurricanes. You buy it in California, there's earthquakes. You buy it in the Northwest, it just rains all the time. I mean, right? And so
we got earthquakes.
You get earthquakes.
Worse than California. Yeah.
Right. And so, and anybody that lives in Minnesota, you get snow on the roof, it then melts, it takes out your rain gutters, then you got like $5,000 to fix your rain gutters or your roof, right? So look, there's all these problems in the place, and you just got to figure out, does the benefits outweigh the drawbacks? And so my takeaway on this, and this is my last call, you guys can stay on longer, but I'll just wrap up here. Look, I'm not happy with the MSTR common stock price. I'm still a very large holder. I have not sold any MSTR shares in my accounts since, I did because I had options, back in, when I reported it in March, I had options. I closed those all out back in March of this year or February of this year. I closed everything out because that's when the tariff stuff started. And I have a post there that I closed everything out. But I haven't sold any MSTR shares the rest of the year. And then I believe that Stretch will go back and hit its peg. He has to maintain that. They want the prefs to be successful. And so my takeaway is I like those products. If you like the products, do your own research, compare them against the yield max products, and then ask questions. I mean, that's where I am. I would much rather be that Bitcoin is at 130,000, but it just isn't.
Yeah.
Yeah. Agreed.
That was your final thoughts, Mike. Jeff, do you got anything we missed?
Yeah, I can keep chatting. There's a couple topics that I think are interesting, but Mike, if you want to run.
Yep, I'm jumping off. Thank you, guys.
I'm probably going to be a few minutes.
No, that's fine. Take care.
All right,
guys.
cool.
Good to see you.
Bye.
Yeah.
All right, we're pulling an all-nighter. You've only been awake for 24 hours. We gotta take it to 36.
Yeah. Okay. So I had a 9-hour flight with 8-hour time change. It feels like 3:00 in the morning for me, and we're keeping it running. I've just had a bunch of coffee and Diet Coke and Coke Zero, so we're cooking here. But I was thinking about credit systems like a lot, just been over this last week, and how like Stretch is working and how it will like operate into the future. And I think there's a very real future where like Stretch is tokenized.
Mm-hmm.
And I think that's like that would be a very large, like a very large thing, right? if Stretch is tokenized, you can start to think of Stretch as like dollars.
Yeah, I was going to say, explain that. Does that mean we get to spend them?
Like you can spend them peer to peer.
Yeah.
And if it's a stable coin, right? If we think it's going to get to like full stable coin, like pegged at 100 or like 99.5 to 100.5.
Yeah.
Which I think what it will be in the long run. It might be 48 months from now. Right. It might be 4 years from now before we like see that like absolute 100 peg, but there's no reason it couldn't be tokenized. And there's no reason that it wouldn't be accepted as a form of currency. Right. I take stretches or whatever, like people are passing them back peer to peer. And then additionally, the seeing other companies start to use Stretch as collateral. So the Bitcoiners probably aren't going to like when I say this, but Stretch is better collateral than Bitcoin. Think about it. Stretch is better collateral than Bitcoin.
Okay.
What's better than Bitcoin? 4x over collateralized senior claim on a balance sheet backed by Bitcoin. It's a hard statement, but like so thinking back to my institutional background with reinsurance, if I were to go try to do a $100 million collateralized reinsurance transaction, and I tried to post Bitcoin as collateral, everybody laughed at me. It's not going to happen. Like it's not going to happen for probably a decade. And it's funny because there's a couple people in the market that are trying to do like some crypto backed collateral, and it's like it's not going to work. But it's much easier to go sell $100 million of Stretch.
Yeah.
If it's pegged at 100 and it's non-volatile and it's printing 10% yield a year and it's rated B, that's much better collateral. It's much more widely accepted. Like a majority of the world is going to accept Stretch as collateral over accepting Bitcoin as collateral.
Yeah. The rails are already in place to like make it happen with a snap of a finger.
And if it's tokenized, it gets even easier.
Wild.
So yeah, so that's what I've been thinking about a lot is like, okay, the credit system that gets built on this is going to be enormous, and it's going to get hypothecated. Like that's the insane thing, right? So one thing that I've thought about a bit is like the amount of credit, Bitcoin backed credit in the market can be significantly greater than the market cap of Bitcoin because it can be hypothecated. So like think about how insurance companies take on risk, right? You've got like insurance companies leverage their balance sheet 4-to-1. And if your balance sheet is a stable coin, if your balance sheet is made up of 100% Stretch, for example, let's just say you're a Bermudian entity, you're not publicly traded, you don't have to worry about 40s Act, whatever. If you're 100% capitalized on STRC, okay, now I can leverage that STRC balance sheet by 4. And I could go take on risk in the market. All right, because it's
because it's 4x collateralized. at the source?
Not necessarily because it's Forex collateralized, because I'm taking on risk that doesn't have 100% probability of happening.
Yeah. Now, so even with a very small chance of an occurrence, given an infinite time frame, like everything that's possible is inevitable. So don't they get wrecked eventually? Somebody does.
Not in a system where where you store your energy and it doesn't decay. Right. So it was funny. I was in London this week, right? I was in the birthplace of insurance, and I was talking to some people about Bitcoin, again, risk. And I sat down and had lunch with a couple of people. And one of the funny stories was like the birthplace or the birth of insurance. Think about a bunch of really wealthy people with a big pile of gold. Okay. And they go insure a couple of boats with some shit on it to go sail across the Atlantic and come back. And if the boat makes it, then they get the gold. If the boat doesn't make it, they pay out the insurance claim and they pay out the gold. So they just measured it over the year. Like, I started with this much gold and I ended the year with this much gold. Like that's a good transaction. And like that's going to be the future of this stuff too. Like, let's just imagine an insurance company that's 100% capitalized on stretch, and any premium that they generate from people that are buying the coverage goes to buy more Bitcoin. But they're using their stretch as collateral. Like, if they need to pay out claims, they just sell stretch to pay out the claims, or whatnot. But I mean, you bring up a good question. Insurance industry has been around for 500 years. I think it will continue to be around for a very long time, because people like certainty in their life. I don't know. We'll see. These are just some of the things I'm thinking about. So my final thoughts are a little bit scattered from spending some time in Europe with some old insurance folks. Anyway,
you're jet lagged to hell. You got more final thoughts?
Jet lagged. No, that's it. I honestly, MSTR looks like a screaming buy here. I have no idea where Bitcoin's going. I personally think it's got room to go significantly higher. I think all the macro, we've got tailwinds behind us. I wouldn't be buying any other cryptocurrency. I want the one that's a monopoly, owning the company that has a monopoly on the monopoly money.
Yeah.
is probably a good trade if you're holding for a long-term horizon. And a lot of people are screaming, but like most, like 95% of my MSTR exposures in my retirement accounts, I'm like, oh, I don't like, I can't touch this for 30 years anyway. So like, what am I going to do? So every dip's a buy.
I mean, I don't know. It can dip. It can always dip more, and cause you some more heartburn. But it's just your investment horizon is the only thing that matters, I think, as far as that's concerned.
Yeah.
All right. So my final thoughts. We really didn't get a chance to talk about the earnings call too much, but there was a lot of good stuff there. But the only thing that I really, really, really wanted to talk about was, like, we have to talk about Ben's question at the end that triggered Sailor, and he freaking launched into like the Braveheart speech. I mean, the only thing missing was him like yelling freedom at the end. It was like crazy. And it was just a normal earnings call up until that point. And then he like caps it off and he says he wants MSTR to stand for monster and they want to eat the world. And I was just like, they are gathering like a Bitcoin treasury army. And these are economic nodes now. So, I mean, we got all the plebs, we're going to get these treasury companies now, and they are going to start, acting in Bitcoin's interest. And I think that's going to be a necessary sway. I think we're going to get a few treasury companies that over leverage and encumber their Bitcoin, or make some terrible decisions like Mara. They decided to mine some Caspa. And I think they were doing like was it OFAC compliance or something, and the community just revolted. They were like, that's not the Bitcoin ethos, so you guys can piss off. And they had to capitulate because their stock price was going down the toilet. So I think the more toxic Bitcoin maxis that start to own treasury companies, I think that's going to be good for the network and the world, because we're going to punish any Bitcoin treasury company that is not abiding and doing what's right for Bitcoin. So I think it's just a good thing for the network overall.
Yeah. I think the reality is the Bitcoin treasury companies are going to be the balance sheet of the world. Like the balance sheet of the world is going to be built on Bitcoin.
Yeah.
Like that's crazy. It's just a crazy statement, but it's true. And it's already happening.
Yep.
So anyway, good stuff.
Thanks, Jeff.
I'm gonna go to sleep. Yeah, great job hosting, Solei. Appreciate the time. So this is
45, baby.
45. I love it. Okay, let's do 46 maybe next week before Thanksgiving.
Thanks everybody for tuning in.
All right, guys.
See y'all.
Catch you later. See ya.